Good morning from my side. I think in the next couple of minutes, we're going to briefly look back on 2025 and reflect on what happened from a financial market return perspective. And then we'll spend some time thinking about what could happen in the future and ultimately where the big opportunity sets are in terms of the big market trends. We all know that last year was a good year for equities, both domestically and foreign. But I think when you think about the sort of outcome, which is a pretty good one of the questions that one should ask is well, what happened if there was an alternative scenario? In the middle of April this year or last year, we had a fundamental problem in terms of the world changing around geopolitics, around tariffs and trade, and yet we still ended up in an advantageous position at the end of this year in terms of a very good outcome. We've got essentially a couple of bull markets which I want to address going forward, because these bull markets, the key question you probably want to know is which of these bull markets are going to persist and which of these are going to reverse. And I think that's really a very important consideration. Now, thinking about the performance of asset classes in South Africa, the rand has obviously done very, very well. You can see from the slide, it's eaten away at the offshore returns. It's obviously eaten away at the offshore returns of our funds as well. But I do think when you look at those numbers, my first important point I would like to make today is that I do think the rand is probably one of those things where you can rely on it being slightly mean reversionary. In other words, it's probably unlikely to have another year of strength, and it's probably likely to pick up an alternative trend. Calling that exact date and time is going to be hard, but it is, in rugby parlance, sort of in the 79th or the 80th minute of the rugby game. Now, in terms of the SA stocks, I mean, clearly the local assets have done very well. You can look at the performance of SA equities, obviously driven largely by the precious metals. And if you look at the slide, you can see that the domestic story is pretty weak. So when we stand up and say we worry about where the growth is going to come from in South Africa, that is still a real concern. Hendrik in the earlier conversation spoke a little bit about bonds and the transformation from a fiscal perspective, whereas that transformation is not actually occurring on the ground level. And at the end of the day, we can't just be a nation of miners and shopkeepers. We've got to be more if we want to be successful and grow this economy. And so when I look at these numbers here, I mean, the temptation for most investors to say, well, let's go and take money out of precious metals, sell gold, sell platinum, and put all our money into these bombed out, underperforming parts of the market. And I'm not sure that that is the right outcome. So this is not one where I would be calling for reversal in terms of the performance of retail. In terms of the big themes, let's talk about AI. AI is obviously a very important driver of markets. What is our view? What is our investment view when it comes to AI? I think the most important way we look at it is to say we agree that whatever is happening now in terms of the world from an AI perspective is going to potentially be a platform shift. So let's think about the positive side. If you take the open AI view of the world, we are going to have a fundamentally new platform. Software is dead. Most businesses that we look at today are probably not going to exist 10 years from now. We're all going to have no jobs. And it's basically open AI has all the money and all the power, and there's some sort of AGI outcome. That is a pathway we could go around. We have a view that probably says that if AI is going to succeed, it has to be adopted by society. In other words, we have to become more productive and we have to become more effective. If that is the world that we are generally moving into, then it has a very interesting implication for the way in which you invest. And for what it's worth, our view would be that that world is definitely going to be more interesting in terms of the opportunity set this creates. What are those opportunities? Well, clearly healthcare is one. Think about it this way. Pharmaceutical companies around the world, big pharma, Johnson & Johnson, Pfizer, GlaxoSmithKline, the shares have been going nowhere for 20 years. Nobody understands pharmaceutical companies because it's all about a pipeline with code words that nobody really understands what they are. And what those companies have in common is an ability to spend truckloads of money on things that make no returns. You throw money into R&D every year and you get nothing back. Do you not think there's a chance that companies like that could use AI to reduce their R&D budgets, to improve the discovery of drugs and cures that actually make a difference in our lives? And then in that process, investors can assign a higher value to those future discounted cash flow streams and put a bigger stock market value on those companies. In which case, a business trading on 12, 10 times earnings might actually end up trading on 20 times earnings. I think those are things that are interesting. It's easy to go back and say a company on 50 or 100 times earnings or 50 times sales, it's very easy to imagine what world you need in order to justify that valuation. But it's far more interesting from an investor's perspective to take the ones where the upside is asymmetric. And that's where we are spending more and more of our time investing. So will this be a positive year for stocks? I mean, we've had 3 good years for global equities. Yes, the trade is broadening out. Yes, it's not all about the US anymore. And those are all good things. But where we've been this year is it's sort of in, I wouldn't say uncharted territory, but it's unusual to have a 3-year return of 21% per annum. So if you look at the distribution profile, normally you don't get that. And it might surprise people, but in any given year, if you put money in the equity market, there's only a 55% chance that you'll get more than 10% out of that market index in any given year. There's a 45% chance that you're going to get somewhere between 0 and 10 or a below zero return. And there's about a 25% chance that you'll lose money. So every year that goes by and you have an outcome which is incredibly attractive, and there's nothing wrong with a 21% return that comes out of global stocks. But what investors need to think about very carefully in this world where there are a number of different cross currents, there are a number of things that are actually behaving in a way that could undermine those return prospects. You've got to think very carefully about what would happen if you'd end up with an outcome which falls in that 45% category. Now, I'm not going to be the doomsday killjoy to come and say this is the year where everyone will lose money, because that's not our central thesis. But I do think that when it comes to a portfolio, and when you think about where we are in all of the funds that we run, we know that you might be disappointed by the fact that the Opportunity Fund has given you a poorer return than all the peers have done in the last year. And I understand that frustration. But the reality of the matter is that when you think about those returns, if you are now full on in the teeth of all of the strongest bull markets, and you're loaded up on all of those things, and something happens, the chances are that your outcomes are going to be very, very different. And I think that that's something, again, that investors should seriously consider at this juncture. Whereas what we're investing in is we're ultimately investing in fundamental earnings delivery. There are lots of stories in the marketplace. There are lots of exciting things to consider. There's lots of hype out there. And those are all nice and good and fun. But investing in the long run is all about the ability for companies to grow. And when you look at what's delivered the track record of our global franchise strategy, which I've been running since 2007, it's ultimately about the growth. It's not about whether people find the stocks interesting, whether they have story value, whether they provide dinner conversation. Those are nice. But in the long run, I would rather take the production of profits, growth of cash flows, fundamental things that actually, where you can value financial outcomes as a driver of returns, rather than the idea that the story value is what drives the outcome. And you can see from the slide here that the biggest reason why our portfolio performances, which by the way have exceeded our expectations in terms of an absolute dollar return outcome, the reason why it's been disappointing is because the markets has not revalued our stocks to the same extent which it's revalued story stocks. And my question for most investors is, if you think going forward, and if Siobhan's chart is correct, that the investment outcome for global equities is going to be somewhere between 2 and 6%, depending on which market you choose, in dollars. That means that there's a good chance that your re-rating component, which has been so kind to investors, might actually be a headwind. And if that is the case, what happens to the fundamental performance outcome? So in simple terms, that green bar on the slide here, if that disappears, what are you left with in terms of a driver of returns? I mean, ultimately, it's going to be the earnings growth. And that's something that I think investors should definitely think about and consider carefully. Now, what about the local versus offshore debate? Now, clearly, domestic assets have recovered quite a lot, but we know that the market has been very narrow. It has been about precious metals and, to a certain extent, process last year and not much else. And this year, you probably could see something of a broadening. Maybe the mining houses do a bit better this year because ultimately fundamental commodities like copper are going to play an important role in the electrification and the rollout of power for the data centers, which are going to be power hungry for the next 5 or 6 years. So there are opportunities within that space, and we do accept that. But the growth story for South Africa is still not here. And the math is difficult to square at the end of the day. If we have inflation sitting at 3%, let's assume that our governor is correct and we hold that level, and growth is still 1. Let's be generous. Let's call it 2. Let's be even kind. Let's call it 3. 3 plus 3 is 6. That's still a very muted top line. So companies have to generate market share gains. They have to gain market share. They've got to have cost initiatives. They've got to be more productive in order to create very attractive financial outcomes. At a time when the actual shape of the economy is narrowing and the tax base is narrowing. Those are all big challenges that I think are quite difficult to achieve. So in simple terms, the foreign direct investments that are happening in South Africa are in the most liquid assets. There's this idea out there that foreigners are going to come and buy the South African Inc. stocks because bonds have rallied, interest rates are low, and the local equities are lagging. So that's got to be the opportunity for 26. The problem with that thesis is that, 1, those stocks are incredibly illiquid. So I'm not going to be buying it off. All the South African fund managers are up to their eyeballs in those stocks. They own big percentages of the companies. They can't buy more. They need the foreigners to come and buy the stocks off them. And they're very liquid. So to expect people to put money into these companies is probably a bit of a tough ask. The reason why investors are in the bond market is because bonds are quite liquid. You can get in and out of your investments in government bonds quite easily. So in terms of what bull markets could persist this year, I do think that the bond market does have scope to rally. I would be switching, for what it's worth, some of the money that's in nominal bonds into inflation-linked bonds. And that's what we're doing in our portfolios, because I think there's ultimately probably better value at the margin there. And then clearly, cash is going to remain very unattractive for local investors. So South Africa's opportunity set is still narrow. One quick word around gold. Obviously, it's a bull market which has been very nice. The problem with gold is I don't think there's anybody in the world that can tell you what the fair price of gold is. Is it 5,000 or 3,000? Is it 10,000? What is the price of gold? What's the fair value for gold? Everyone's got opinions on gold. Everyone tells you what the direction is. But what's interesting is I think the trading behavior of these assets sometimes matters more than the valuation. So what I mean by that, we had a new governor appointed. Chairman Walsh is going to take over sometime in May if it goes through in the US. What's interesting about that appointment is as a governor, he is anti-balance sheet expansion, which means he wants to rein in the supply of dollars, whereas Trump, the last time I listened to him, he wanted lower rates and a faster growing economy and more stimulus. So there's going to be quite an interesting battle between this new governor and what Trump wants, and I don't know how it's going to work out, but let's see. And gold has responded to that, and that was one of the catalysts for sudden reversal in the price of gold. And when you look at the trading behavior of an asset which has been very bullish for a very long period of time, when you start seeing this kind of volatility, it often tells you that the market is starting to think about whether there's a reversal in trend underway. So when you can't trust value, you have no idea of what it is, you got to look for other signals. The same thing happened with Bitcoin a couple of months ago. Bitcoin is, let's call it, all but halved in the last couple of months. And without any fanfare, there was no catalyst. Everyone said, well, how can Bitcoin fall? It's supposed to be alternative for stocks. It's supposed to be the world's debt problem hasn't gone away. The dollar hasn't suddenly created a bull market. The world hasn't become a safer place. Geopolitical tensions are still there. Nothing has changed on that front, but the price changes. So the trading behavior of these assets are probably more useful to watch than trying to understand value. In terms of outcomes, then, before I conclude, when you look at the opportunity set for investors in South Africa, there is still money to be made. I know that people think inflation plus 6 is easy. I think in the fullness of time, I think inflation plus 6 is going to be hard. I think from this point onwards, I know a number suggests that there's good returns to be made, but I think you're going to have to work hard for those returns. They're not going to fall out of the sky and not going to be generous. So when you look at this table, let me make this point very clearly, because I know sometimes people get confused. The SA listed local equities and the SA listed global equities are clearly stocks that are on the JSE, but those are the stocks that we would own in our portfolios. Yes, we are arrogant enough to suggest we think our stocks are going to outperform. So I make apologies for that. But this is not a blind index purchase that you're going to make. So the index stocks are probably going to deliver low returns, and the same with global equities. Bonds and inflation bonds are a little bit more difficult to create massive outperformance over the index constituents, so they are more index-like in terms of their characteristics. But those returns are still, we think, doable. And it's not a function of having to rely on a massive amount of a re-rating in those assets. So when you look at our mix of opportunity fund, for example, we use the term balanced, not bearish. And I do think that in a world where multipolar risks are growing, you can have conversations about very different directional outcomes. We know that we have very creative politics. At least Greenland has gone quiet for now. But I mean, look at this. A month ago, we were worried about whether or not the Arctic Circle would become a battleground. So these things come and go. And at the end of the day, those events change the pricing of assets as well. And we don't know what the next iteration is going to be on a range of different outcomes. So the reason why you can't just allocate to what you think is going to work in the long run, and in the long run we think that equities will deliver the outcomes, is because you need to try and facilitate some degree of handbrake or shock absorbers on this ride, because the roller coaster ride for investing, I think in 26 is going to be more than what it has been historically. I don't want to wish upon volatility on anyone, but I do think this environment is more likely to be volatile this year. So those other asset classes that generate counter-correlated impacts on your portfolio are going to become more important this year than what they have been for the last couple of years. And I think that's really, really critically important to understand, that when you put your portfolio together, that you don't bet the farm on things that have worked well, particularly in the last 12 to 24 months. So concluding then, for long-term wealth creation, I still think that the stronger growth that you will find outside of South Africa will provide the base case for your good returns to be owned. We are desperate to find the growth story in South Africa, but it's still elusive. We're looking, and let's be clear, we're not tone deaf to the marginal changes which have been positive in South Africa, but we need to see that translated into growth in order to change the platform paradigm with regards to a wider set of opportunities in South Africa. SA bonds, I think, still have potential to rally, but we are 90% through the rally in SA nominal government bonds. The rand is potentially at risk of a major price reversal. How does that happen? Well, think about it this way. One of the gifts we were given as a country is precious metals were high and the oil price has been low for the last 12 months. What happens if the oil price actually starts going up and gold falls? Our terms of trade unwinds. Suddenly we don't have the mining royalties that have helped the fiscus. We're scratching around for revenue again, and then the virtuous circle changes very quickly. So just bear in mind that these things could happen. We're not forecasting them, but they can happen. They can change very, very quickly. And that's ultimately why this balance is really important. So I don't want to be somber this morning, but I think there is opportunity out there. But I think not betting the farm on everything that has worked is probably also going to be a prudent strategy going forward. So thank you very much. I'm going to hand you over to Jeremy.